Have we avoided the correction? Welcome back to the weekly market analysis for the week ending May 19th, starting off with the S&P 500. I projected last week in last week's video that we would have a correction. We looked at a couple of different things to show why that was. And this week, instead, what we got was a pretty substantial squeeze, especially in tech. And we'll jump into that in just a minute. Obviously, in the S&P 500, the top 5 to 7 largest cap stocks are they make up the largest percentage of the market cap weighted index, and so as the Nasdaq goes up, so too the S&P goes up. But we'll get to that the Nasdaq in just a minute. The S&P right here, what you'll see is I have a Fibonacci some Fibonacci levels on the chart to kind of give you an idea of where things are at. The level that we were battling with has on the upside, I should say, has been pretty important because it's the 50% retrace level on the bear market, and I'm using closing levels, so closing high to closing low, and so obviously this is a really big important level and that we finally pushed up above and got a really strong close above. On yesterday's price action, just the last 2 days just really kicked it into overdrive, and so we closed today at a little over 4,200, and so obviously markets are higher now than over the last few weeks, as I have personally been calling for a correction. So the question that I'm looking at right now is the correction now nullified? Are the conditions different? And our market's poised to now move further up. We got some price action today. Today was OPEX, and if I remember correctly, I'm not 100% certain about this, but if I remember, the upper bound kind of call wall area was around 4,200, and so definitely there were a lot of people that were talking about the upside potential being around 4,200 for the May OPEX, which closed today. And so now that pin is going to be out. So some people give that a lot of weight. Some people don't. So just want to be aware of that. But we did get kind of some muted price action today, a little bit up, a little bit down. Not really closing very far off the open today. And so I do want to just call out that even if so we're above the 50% retrace. On the S&P, what I want to call out and be aware of is that this is actually the second time now that we've gotten a close above a 50% retrace. So the first time that happened was over here off the June lows. We got a bounce above, and I just want to remind everybody that on this bounce, when we cleared the 50% retrace level, everyone was calling a new bull market. Everyone said, oh, 50% retrace, new bull market. We were, I don't even remember exactly. I want to say we were 20% off the lows. No, not quite. Not quite 20% off the lows. And so everyone thought, okay, new bull market. And that's obvious. That obviously rolled over and went to make new lows. And so I do want to just call out the fact that getting above while many will herald the getting above the 50% retrace as the guarantee that that we are now in a new bull market and that the trend is gonna we're just gonna keep going up and up and up. Not necessarily. I do want to also call out, as I'm going to put this in the background. I do want to also call out on the tide indicator that the tide is still bullish, this colored line being above the faded control line obviously indicates bullish structure, so we do want to be aware of that. And I'm really interested in what next week's price action is going to be like with thinking about whether or not OPEX, the end of OPEX, has any power over the direction of markets over the next week. Let's take a look at the Nasdaq. Just squeezed like crazy on the Nasdaq. So again, I did another Fibonacci retracement here because I wanted to take a look. This one is a little bit different on the Nasdaq. We've gotten a couple of different retraces on the Nasdaq. So we obviously got up above our 50% retrace on this move. On a couple of our moves, we got up to the 618. And then last time on the June lows didn't quite get up to the 0.5. So I do want to call that out. Oh, whoops, excuse me. Sorry, I didn't mean to do that. And so all that is to say, this is a pretty big achievement. But what I've actually, one of the things I kind of, you kind of abandon things for a little bit, or you pay less attention to certain things. A while back, I don't remember if I had it on the videos, but I had this kind of ascending wedge. I've definitely posted tweets, I think, with this over the previous few months. But basically something like this ascending wedge. And what's really interesting is that, and this is just for my own reflection. This is not really anything that is necessary for you guys per se, but definitely right around here, I was thinking to myself, because I was looking at this pattern, I was like, well, sounds like, I mean, we could break down, and I wondered if we would break down here. But I'm looking at this and I'm like, well, we could break down, but we could bounce and we could go to the top of the range, to the top of this line, which, at the time over here, I was trying to guesstimate exactly where that could be. It was really hard. It's really hard to tell. You can't tell the future. You can't tell where price is going to move. Things don't always move linear in a linear fashion. But here we are now, where yesterday we almost pushed right up into the line. We got really close. And then today we wicked up into it. And so it turns out that the market likes that. And the big question is going to be, what's going to happen now? Are we going to get this to pop above? If it pops above, breaks it, and then retests it and moves up, that's going to be super bullish. Like when these ascending wedge patterns break to the upside, because often they do break down, but when they break to the upside, it's super bullish. So I want to call that out, and then but then also suggest that that price could come off. And then it's going to be really important to see what happens if we bounce off of that and back up, if we break down and then go sideways, or if we break down and kind of waterfall down. Typically, the rules of these ascending wedges is that typically a target area is wherever the second wick is touching. So that's going to be somewhere around here, depending on which wick you're using. And so that level is right around it's basically just below 12,000, which is pretty substantially down. So I don't know if it's going to go down there. I'm not saying it will, but that's something to watch out for. But definitely this is not a place that you want to be somebody chasing, because let me take a look. Let me pull this up here. If we look at the NASDAQ, what you'll notice is if you look at the bottom panels, overbought on the stochastics for the week and for the daily. We now have a true MACD histogram divergence, both on the daily and on the weekly. And so I want to call that out as well. So next week is actually setting up to potentially be finally, hopefully, we'll see. And I say hopefully because obviously you never want to be chasing price, and you always want to be able to buy something at the lowest possible price. And so being patient and waiting for a correction is the right thing to do, to try to buy off a level where there is clear risk management. But obviously waiting for that is often challenging. So and then you can see that the very bottom panel, it's the RSI, the weekly RSI is almost at overbought, and the daily RSI was overbought and is now starting to come off. And so then this is the reason I'm pointing that out is because, to go back to the main chart, you don't want to be chasing. And the biggest tell on that is, look where the tide line is. So I like to, in this system, what you want to do is you want to watch for price to trade down below the control line. Even if it's just a wick, getting a wick below the control line is great risk to reward, as long as the tide line is above the control line. And so we are obviously in a bullish setup here, but when price is this far away from the tide line, it's overpriced on a relative basis. We're not even talking about fundamentals. We're talking about on a technical basis. It's too expensive. And so when I say hopefully, all that is to say that hopefully for long entries you wait for that that pullback there. You don't want to be chasing up here, especially into resistance. And you don't want to buy the breakout. You want to buy on the retest and resumption anyway. So even if like one level, if you take the August 2022 high, the best thing you could do is if we don't come down to the tide line, the next best thing would be to potentially, with proper risk to reward, is to take a successful retest and resumption off of the June high, which is around 13,740. So just calling that out. But yeah, and I'll get into again why I still think the conditions are there for a correction. There some of these things took a hit, but definitely there are still some warning signs out there. The Dow, here's one warning sign. The Dow is not following through. The Dow has been kind of stuck sideways basically since December, and so it's not following through. And the thing about the Dow is that it's actually equal weighted. It's an equal weighted index. It's only 30 stocks, but it's an equal weighted index. And I think that that's important because your Apple and Microsoft, which are also part of the Dow, the DJIA, those don't overweight. So when the price action in those stocks outperforms, it doesn't push the index further just by virtue of the heavier weight. So I think that that's really important. So the Dow is only 30 stocks, but it's a good breadth indicator as far as the large blue chip type stocks are concerned. And that's sideways. And then the other thing too is the Russell, which has gotten a little bit of a bounce here at the end of the week, or towards the end of the week, sold a little bit off today, but is very bearish actually. And it's looking like, this kind of looks like I don't know, does this look like a Head and Shoulders to you? Something like that, I don't know. I'm looking at a line that's maybe something like that. So if it breaks down, that's going to be really bad. But in any case, the relative underperformance is striking, to say the least. So on the equity indices, one of the tools that I use, I featured this last week, is this. I added something to this. It's my risk overlay, and it basically looks at a couple of my risk proxies, which is relating to high beta, low beta, and then as well as junk versus treasury debt. And last week I called out that the weekly close showing up as the red candle here signals that a correction is imminent. And I went, check out last week's video if you're curious about it. You could check out on Twitter. I talked about it, but basically this is this was back tested, and on average the average drawdown is 13%, and obviously this going back to a neutral signal here, a yellow candle. Comes from as a result of, let me go find the high beta to low beta ratio here. High beta to low beta just had an incredible week. If we just go to Monday, Monday's open, even just through yesterday, was up 7%, and that was enough to push price back above the tide line and drag that tide line right back barely above. So here's the warning. Next week's price action will be important, because if high beta underperforms and drags this back down, we could get that bearish cross again. I'm not saying that we will. It's really hard to tell, but that could happen. And there's precedent for it in this indicator too. If you come back, there's precedent for a couple of things. One, there's a precedent for, if you look here, this was in 2018. There's a precedent here where we had bearish risk signal, and then it actually turned back to neutral before turning bearish again, and then that's where we got the drop, the 20% drop. That's happened also. We got a little bit of a drop back here in 2015 when we first got the signal, late 2014. Got a little bit of a drop, and then it came up, and then our 10% plus drops actually came. It was 2 in succession. Actually came after the second signal. And then obviously we've had occasions. So the point is that the indicator tells you. Actually, I can't look back here because it's all messed up, because the data doesn't go back far enough. I do want to call out there are a few instances like this where you get the bearish signal, but then it turns to neutral and nothing comes of it. So you get a little bit of a price drawdown, but not something that's prolonged and not something that's over 10%. So that happens, but those instances are statistically rare. So could this be one of those statistically rare signals of the last 27 years where price doesn't actually get a significant drawdown and just moves up? Sure. Okay. What I did was this. So I have the color overlay, which is tied to whatever the risk signal is. You see that on the top right portion of the chart. But then I'm also tracking breadth and then liquidity. And I have a couple of proxies for how I measure breadth and liquidity. And to see the red signal diminishing and the red signal decreasing for breadth and liquidity respectively suggests as well that there's still high risk in markets for things to correct. What I'll be watching for next week is will we come back to a bearish risk signal? So that goes to ultimately, will the high beta low beta ratio come back off? Because the junk to treasury ratio is still pretty solidly in bearish tide. So that is something that I expect to hold at least for a little while longer. And so the definitely high beta to low beta is going to be the thing to watch. Speaking of liquidity, if this chart will pull up, I've been tweeting about this quite a bit this week. The divergence in global liquidity from equities has been laughable. I mean, it looks like a megaphone. I mean, it's like if you just see on the right side of my screen, it's a megaphone. And these, I mean, this is very strange. Anytime there's been a divergence, any sort of divergence from the direct, it's not even necessarily like the space, because obviously if you look at the chart on the left side here, kind of during the summer bounce, obviously price had come down well below where net liquidity was, and then came way above. I'm not talking about necessarily that. I'm talking about a divergence of directions. That's, to me, the thing that's crazy about this, is that usually when global liquidity is usually global liquidity and equities go the same direction. And so if liquidity is coming off, then usually the equities are coming off. If it's going sideways or up, then usually equities are going sideways and up. Well, liquidity since the end of March has been coming off pretty steadily, and yet equities have gone the other direction, especially the NASDAQ. The pink line is the NASDAQ, by the way. And so, I expect, sorry about that. Sorry.
Alex Martinez.
Oh, sorry about that interruption. I'm doing this live. Anyway, if you go back, whether you want to talk about all across 2022, if you want to go in the period post-COVID up to the top, if you want to go right up to the COVID lows, think about, you see, markets have followed liquidity basically since the GFC. So all that is to say that all that is to say that I expect, because it has been this way, I guess you have to decide, do you think this time is different? If this time is different, then what you're saying is that liquidity has no bearing on equities. And if that's the case, then, nobody should care whether or not the Fed pivots or not, because it's not really about liquidity. But if it is about liquidity still, then you should expect that these lines up here are going to come back down and meet liquidity. And so that's the other thing that I keep looking at, that suggests to me, along with my signals here, risk aside, that there's still I still am a little bit concerned about this correction, and just because of the oversold, or I'm sorry, the overbought nature of the markets. So let me. Oh, this is on the wrong screen. Excuse me a second. Let me pull up really quick. This is going to be a little bit odd. Sorry about the transition here. Things just going crazy today. This is something that I use periodically for to show where different assets are in relation to their relative strength and their 1-year Z-scores. And what you notice is that, so you've got, if you can't see it up here to the top right, you've got the Qs, you've got mega cap growth, you've got technology, you've got small cap growth, you've got communication sector, all and S&P growth. All of them are high 60s, and in the case of mega cap technology and the Qs NASDAQ ETF are all way overbought from the perspective of the relative strength index, and their 1-year Z score is positive, which suggests that they've outperformed on a relative basis. And so you want to be like, when you see signals like that, a lot of signals like that converging, to me, that's where you want to be cautious. And so that extra dive on equities. And the other crazy thing is that all of this price action has happened with the dollar having come up. Let's see what the dollar, even on today's close, the dollar is up almost 2% and was up over 2% over the last week. And 2% doesn't sound like that much. That is a lot when you're talking about currencies. And so I think that's been something that's really interesting to behold, is that the price action in equities has not followed the typical script. It has the equities have risen with the dollar, and equities have also risen with yields, and that's another thing that's really interesting, because the 10-year in 1 week has gone up almost 9%, and still tech has rallied, and especially tech has rallied in the last week. What I do want to call out on the 10-year is that I called this out previously, but there was a bearish cross on the tide, and I have done some work to talk to share about how the last time we got that cross was August 2021, but that cross didn't actually last. It crossed back to bullish just a month later, and then wondering if it was going to be like that, or if it was going to be like our previous the previous cross before that, which was in December of 2018, right around the time that Powell was about to pivot, and then the 10-year actually fell by about half, or by more than half, even before the COVID lockdowns took place, or by about half before the COVID lockdowns took the yields down even further. Well, it's crossed back up to bullish, and the first area that I would look for for resistance is going to be on this descending trend line, which right now is coming down at about 3.9-ish, 3.92. So that's something I want to call out. And then let me show us gold. I did a big thread on gold on Twitter recently. You can find that. Basically, I've been saying for a while I don't see all-time highs on gold until 2024. That's just my personal opinion. I think it's going to happen on the far side of recession, not on the near side, and I do believe a recession is coming. Technically, this is a pretty good spot for gold to see a little bit of a bounce, but precious metals is something that I called out in my newsletter on Sunday. Speaking of my newsletter, you could check out my newsletter at befinanciallyfree.substack.com. If you are a premium subscriber, then you could have seen my trade ideas in the precious metals space, of which I called out the fact that all of the precious metals, gold, silver, and then their miners were due for a pullback. And I mean, if you look at it on the weekly chart, gold came off, over 1.5% today. Silver came off, well, a little bit less. And then what I wanted to really call out was, GDX, the gold miners. Gold miners were off over 4% this week. So again, those are signals that you would have seen if you were a subscriber to my newsletter, a premium subscriber. And then I'd also like to remind you, you can find me on Twitter at Mr. J. Thomason. I've mentioned Twitter a few times. Links to those, by the way, are in the description of the video below. So yeah, metals have been coming off. Crude is kind of just stuck here around the 70 to 72 level. I'm actually expecting this to come down further. So, it's not that I don't disagree with the supply story, but it's more and more obvious that the demand story is not there. So that's the issue on crude. And then I want to take a look at a couple of stocks. Let's look at NVDA. This has obviously been the big mover. Just look at the move since October. In October, it closed down as low as, it closed down as low as 112, and it's up almost 3x since then. Well, actually, that's not technically accurate. I'm sorry. Let me just do this measurement. It's up 176%. That's insane. It's been moving like crazy. By the way, NVIDIA is I want to say it's the 7th largest weighting in the S&P 500, and I think it's about the same for the NASDAQ. And so as it goes, it's pulled a lot of weight, honestly. Then you have MSFT, that's Microsoft. See if this will pull up. The computer's being a little bit slow. Microsoft, since November, has been up almost 50%. And then let's pull up Apple. Apple and Microsoft both are almost back at all-time highs. Apple's up 40%. Let's look at Google. Google's gotten a big push lately from the AI story. So, just look at in the last, since Monday, May 8th. So in the last 2 weeks of trading, it's up almost 20%, it's up 17.5%. And since the lows, Google is up almost 50%. And then the last one I wanted to look at is Amazon. Amazon has been doing better the last few days. Even Amazon is up since December, is up 42%. So that's kind of where the gains in the market are at, because the breadth of the market is not there. This is the percentage of stocks below their or above their 200-day moving average, and that number is 47 right now. So less than half of the stocks in the S&P 500 are even above their 200-day moving average. So the breadth is really small. So for all these reasons, again, I still think it's prudent to be aware or to limit your risk in the case that these different signals are indeed, or that these markets are, in the case that these markets are indeed exhausted. But anyway, that's where I'll stop for this week. Thank you for tuning in. Again, sorry about some of the technical difficulties and the interruptions on the video. Thank you for watching. If you've made it this far, don't forget to like and subscribe, and I'll see you guys next week.